If you're a fan of growth stocks, the stock market could be getting very choppy for you. The Federal Reserve is talking about raising interest rates over the next several months, while the World Health Organization is talking about a new pandemic variant called Omicron. In my opinion, we're about to enter a big tug of war. On one side, we have inflation and interest rates pushing down growth stocks. On the other side, we could have another round of the pandemic, which would force companies and individuals to move even more of their routines online and adopt new technologies as a result. So in this episode, I'll tell you exactly what I'm watching out for, how I'm prepping in my own portfolio, and how you can do the same.
Now's our chance!
Your time is valuable, so timestamps are enabled for your convenience, and we can get right into it. The first thing I'm watching out for is the Federal Reserve's plan to taper their quantitative easing program. If you don't know what quantitative easing is, it's this. Quantitative easing is actually where the Federal Reserve increases the money supply to encourage investing and borrowing by buying bonds on the open market. So when you hear big news channels talk about tapering, what they're actually talking about is the Federal Reserve slowing down how many bonds they're buying month over month until they're no longer buying any bonds at all. Once that happens, the Fed can begin raising the federal funds rate, which is also called the overnight lending rate. Currently, that rate is close to zero. The federal funds rate is the interest rate that banks charge each other when they borrow money, which in turn determines the short-term interest rates that banks and other lenders charge companies and individuals to borrow money from them. Rising interest rates are bad for small-cap growth companies because it now costs them more money to borrow money, which they sometimes do to reinvest into their own growth. Also, when interest rates rise, bond prices usually fall relative to their returns, making them much more attractive investments in general. When that happens, risky growth stocks tend to look riskier, since they have to provide an even bigger return to outperform bonds that just got cheaper. Inflation and interest rates are a real double whammy for growth stocks, which is why ARK Invest's funds are so sensitive to them and why they've been underperforming the market all year. If you're looking for a get-rich-quick channel, you're in the wrong place. That said, I'm paying a lot of attention to how exactly the Fed plans on tapering and when exactly they plan on raising this overnight interest rate as a result. The Fed is currently buying $120 billion worth of bonds each month, so if they begin tapering that amount by $15 billion a month, it would take them 8 months to stop printing money. That puts us around July of 2022 if the Federal Reserve rate keeps that pace of tapering the entire time. Based on comments from a number of Fed officials, market pros now expect the central bank to discuss at the December 14th and 15th meeting whether they should move even faster to end their quantitative easing program, which would mean interest rates could start rising earlier than July of next year. The market isn't pricing that in right now, but I bet they will start pricing it in by, say, March of next year. Since we know this is going to happen by next summer, if not sooner, I'm going to get more cash together than I normally would and slow down my buying in the immediate term, unless one of my favorite stocks dips very hard. I'm looking at you, Stone Stock. Yeesh. I'm not a financial advisor and this is not financial advice, but in my opinion, you shouldn't be afraid to keep cash and cash-like positions on the sidelines over the next few months. What is a cash-like position, you ask? I'll explain that in a minute, because this idea also has to do with the second thing I'm watching, which is the pandemic's new Omicron variant. The World Health Organization assigned the Greek letter Omicron to a newly identified COVID variant found in South Africa, previously referred to as the B11529 variant. Here's what we know so far. According to CNBC, the Omicron variant contains around 50 mutations, more than 30 of which are found in the spike protein, which is the part that lets it enter human cells and cause the infection. The issue here is that the spike protein is the target of most vaccines, so mutations in this protein raise concerns that the variant may be less affected by vaccinated populations. There are lots of things that no one knows about the Omicron variant just yet, including the full impact of these mutations and how severe the symptoms could be for those infected. I'm not here to tell you what the right government response is, or if there should even be one. What I am suggesting is that we remember what happened in the stock market and the underlying companies the last time this happened. Big market overreactions to headlines, travel restrictions, supply chain issues, customers stocking up on goods, and capacity limits for in-person services and experiences. Think about what this could mean for a stock like Disney. Will Disney go down because of their theme parks, or will it go up because of Disney Plus and their other online offerings? What about all the companies that already grew a ton because of the lockdowns last time? Do we really think they have room to grow that much again? That's the tug of war I'm talking about. I'm not saying I have the answer here, but I am saying that asking these questions for every stock you care about right now could pay off big time in the immediate future. It's also important to understand what will be different this time. For example, the money printer won't be going burr because of the whole tapering thing I just talked about. Fintech stocks could get hurt twice as hard. This new Omicron variant could make people tighten their physical and digital wallets, while interest rates rise, making borrowing more expensive, and their stocks look riskier than they would otherwise. Again, the idea is to spend more time thinking about the risks we're exposed to right now and slowly correct them before the market corrects them for us. There are a few things that I think we can be watching to stay informed and make those corrections. The things I'm watching for here are the CDC's responses to the mutations of this new variant, and if the Fed changes their tapering plan at all because of it. For example, if Omicron ends up having a larger than expected impact this winter while it's cold out, maybe the Fed will take a little longer to taper quantitative easing, which would buy businesses a few more months of favorable borrowing conditions. It could go the other way as well, where all the different mutations and variations of Omicron don't really amount to much, and that would embolden the Fed to taper even faster and raise interest rates while the economy stays strong. Since I obviously have no idea what's actually going to happen, my plan is to build more cash, spend it slower, and spend it on cash-like positions. Cash-like positions are companies that are less volatile because they're more predictable. Think Apple, Microsoft, Facebook, Google, and Amazon. They're also companies that have high amounts of stable free cash flow and large cash reserves, so they don't really need to borrow as much money in order to grow. They're also pretty defensive stocks. Are people going to be using Google and Amazon less if the Omicron variant ends up being a serious issue, or will people end up using them more? This is actually one way that Cathie Wood uses big tech stocks to prepare for crashes and corrections as well.
Apple was one of our cash-like instruments. It's an innovative company, but its characteristics are very defensive. So we will add names like Apple, the FANGs, Apple, Google, Facebook. We will add to those positions. As a bull market, our portfolios were up 150%. We knew there was going to be a correction, and we just wanted to have very liquid stocks.
I actually made an entire episode about it called Cathie Wood Prepares for a Crash. That episode talks about how ARK Invest's funds spread out among cash-like holdings in bull markets and concentrate down to their highest conviction stocks in bear markets. If you're interested in learning more about that, I'll leave a link to it in the top right-hand corner of your screen right now, and in the description below as well. So, here are a few more things that you can watch to keep a pulse on the market week by week. We talked about the Federal Reserve's tapering rate, which is currently set to be $15 billion less each month. A higher number than that means interest rates could rise sooner than July, and a lower number extends that timeline past July. I also talked about the Omicron variant, the number of mutations, and what that could mean for businesses. So, keeping up to date on those statistics could give you an early warning sign for stocks that rely on selling physical products versus online services versus in-person experiences. Again, think Peloton versus Netflix and Disney versus American Airlines. The third thing you can track is the American Association of Individual Investors Sentiment Survey. The AAII Sentiment Survey asks its members the same question each week. What direction do they feel the stock market will be in the next 6 months? If you want to be greedy when others are being fearful, and fearful when others are being greedy, you first have to know whether people are being fearful or greedy, right? Lately, according to this survey, expectations have been getting less bullish and more bearish, so people are getting more fearful. The final thing I like to track is actually a little sneaky. Like I mentioned, ARK Invest's funds are spread out over more positions during a good market for growth stocks and concentrated into fewer, higher conviction positions during big dips, especially when stocks like Tesla or Teladoc or Coinbase are trading at steep discounts. So, I track what I've been calling the Cathie indicator, which is a count of the number of stocks in each of ARK Invest's funds over time. When this indicator is down, it means that Cathie Wood is selling her cash-like positions to buy her highest conviction ones. When it's up, she's building more cash and waiting for the next deal. That's not me trying to time the market or telling you to go and try to do the same. It's just a good way to keep thinking about your own cash position, including any cash-like stocks that you're currently holding. You can go to www.ark-funds.com, download the holdings for each fund daily, and keep track of the number of positions in each fund over time. When it comes to doing your own research, I always encourage investors to go straight to the source. But if that sounds like too much work for you, no problem. I made an absolutely free Google spreadsheet that automatically updates with ARK Invest's latest holdings every day. That's an easy way to see all of their funds in one place, and you can just write the number of holdings down each day. You can also see how much money Cathie Wood has in every growth stock across every fund she manages. I'll leave a link to that ARK ETF calculator for you in the description below as well. Or if you'd like to have access to a plot that tracks this number over time, instead of having to record it for yourself, my patrons on Patreon and channel members right here on YouTube have access to my Cathie Indicator dashboard, which I update myself each day by hand. Currently, that plot is showing that Cathie Wood has concentrated the ARK Invest funds down a bit through September and October, and now they're holding pretty level. I'll make an episode updating you on that as soon as I see it changing. Sometimes my supporters catch it even earlier than I do. If you're interested in those updates, consider investing in the like button and subscribing to the channel with all notifications turned on. Regardless of what you choose to do, I hope this episode helped you understand a little more about the Federal Reserve's plans for tapering, the latest news on the pandemic, and how both of those things could affect the prices of growth stocks over the next few quarters, as well as how you can start preparing for that today. After all, this is the channel that invests in you. Thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.